All right, so today we're diving into some serious investing wisdom.
Oh, yeah.
We're talking Benjamin Graham's The Intelligent Investor.
Classic.
And you specifically wanted to dig into Chapter 11,
Yeah.
all about security analysis.
Right.
So think of this deep dive as like a crash course in Wall Street thinking,
Okay.
but without all that jargon and stuffy suits.
Love it.
What I find fascinating about Graham's approach,
Yeah.
is that he doesn't just like bombard you with formulas.
Right.
He wants you to really get those underlying principles, to see beyond the numbers,
Yeah.
grasp the true nature of a business.
It's like he's saying, don't just crunch numbers.
Uh-huh.
Be a business detective.
Exactly.
Yeah.
And he starts us off kind of back to basics
Okay.
with the foundation of any good portfolio,
Oh, yeah.
bonds.
Bonds.
You see, Graham is all about safety first,
Mm.
especially when it comes to bonds.
Mm.
He brings up this concept called coverage, which basically tells us how easily a company can cover its interest payments with its earnings.
Mhm.
So it's kind of like a stress test
Yeah.
for a company's finances.
I like that.
So the higher that coverage,
Right.
the less likely a company is to, default on its debt,
Yeah.
like a bigger safety net.
Precisely.
Okay.
And Graham actually provides specific benchmarks
Oh, interesting.
for different types of companies.
Okay.
For instance, he suggests that a utility company
Mm-hmm.
should aim for a coverage ratio of at least 5,
Okay.
meaning their earnings should be 5 times greater than their interest expenses.
Makes sense.
Yeah.
Utilities are, generally safer investments.
Mm-hmm.
They should probably have a higher bar for coverage.
Exactly.
Now, what's really interesting is
Hmm.
Graham doesn't stop at just these like simple ratios.
Okay.
He acknowledges that,
Yeah.
the world is constantly changing.
Sure.
These static benchmarks may not always tell the whole story.
Right.
So he's not giving us just like a rule book.
Yeah.
It's more like a framework
I see.
for thinking about risk
Makes sense.
and safety.
Mm-hmm.
Yeah.
He gives us this alternative way to view bond safety,
Okay.
which is based on the percentage earned on the principal amount of the debt.
Okay.
It's like, hey,
Yeah.
even if a company technically hits that ratio,
Right.
we need to know it's actually earning enough on its investments to justify all that debt.
It's like making sure your income is growing faster than your expenses.
Precisely.
It makes you think.
He doesn't stop there.
Oh, there's more.
Oh, yeah.
Okay.
He talks about other factors that can impact a bond's safety:
Like what?
the size of the company,
Okay.
stock-to-equity ratio,
Which, remind me again.
how much cushion there is for bondholders if
Right.
things go south,
Oh, right.
and even the value of its property,
Yeah.
although he does say that's less important
Interesting.
than earning power in most cases.
So it's like a multi-layered security check.
Right.
Looking at the company from every angle
Exact.
to assess its like overall health.
Exactly.
Now, I know what you're thinking.
What am I thinking?
Can we really predict the future based on the past?
It's a great question,
Right.
and one that Graham tackles head on.
Okay.
He argues that history shows a strong correlation
Okay.
between bonds that met those really strict tests
Uh-huh.
and their ability to, survive future problems.
So, like, while the past may not perfectly predict the future,
Right.
it can offer some clues
Yeah.
about a company's resilience.
Exactly.
Right.
And he even uses some historical data.
Okay.
For example, he looked at
Yeah.
railroad bankruptcies
Oh,
and found that those with poor coverage, they almost always failed.
interesting.
But the ones that met his standards,
Yeah.
they tended to make it through.
Mm-hmm.
And he saw a similar pattern with public utilities, really reinforcing that link
Yeah.
between past performance and future stability.
That's pretty convincing.
It is.
It makes me feel like these tests
Yeah.
aren't just random rules.
No.
They're grounded in,
Yeah.
real world outcomes.
Exactly.
That's what I love about Graham.
What's that?
He's not just theorizing.
Mm-hmm.
He's looking at the market data,
Right.
drawing conclusions based on real evidence.
He's data-driven.
All right, so
Yeah.
we've established Graham is big on safety when it comes to bonds,
He is.
but what about stocks?
Ah, yes.
How do we apply his principles to, the sometimes crazy world of stocks?
Well, that's where things get even more
Yeah.
interesting.
Okay, lay it on me.
Because with stocks, we're basically trying to predict future earnings,
Right.
which, as you can imagine,
Yeah.
is tricky business.
It's like predicting the weather, right?
Yes.
But with way more variables
Totally.
and way higher stakes.
Exactly.
Hey.
And Graham he acknowledges that right from the get-go.
Okay.
He explains the standard approach to analyzing stocks.
Mm-hmm.
You analyze past beta. You project future sales based on economic forecasts, industry calculations,
Okay.
and then you apply a multiplier to those projected earnings to get a valuation.
Sounds complicated.
It can be.
Yeah.
And to show just how challenging predicting a company's performance can be, Graham shares this cautionary tale.
Okay.
He uses value lines projections for the years 1967 to 1969.
Oh, wow. Okay.
Now, their overall market forecasts, they were decent,
Okay.
but many of their individual company predictions were way off.
So even the experts get it wrong sometime.
They do.
So what's the key takeaway for us?
Diversification.
Predicting which companies are going to win or lose.
Yeah.
It's so difficult.
Right.
So spreading your bets across a bunch of different stocks helps lessen the risk.
Like, don't put all your eggs in one basket.
Exactly.
All right, so let's get into how analysts actually value stocks.
Okay.
Graham mentions this thing called the capitalization rate.
Or multiplier.
Right.
What is that?
Basically, how much investors are willing to pay for every dollar of earnings.
Okay.
And here's the fascinating thing.
Yeah.
Two companies with the same expected earnings might have totally different valuations.
Why is that?
Well, that multiplier
Yeah.
is affected by a whole bunch of things.
Okay.
A company's long-term prospects, management quality, financial strength, even its dividend history.
So it's like, okay, we know what the company's earning today.
Right.
But what about its potential?
Exactly.
It's like looking at a house.
Yeah.
You don't just see the square footage.
Right.
You consider the location, the condition, potential for appreciation.
Precisely.
Now, to show how market sentiment can be tricky, Graham gives this example from 1963.
Okay.
Back then, the market loved chemical companies, giving them higher multipliers than oil companies.
They thought chemicals were the future.
Exactly. But guess what?
What?
The oil stocks ended up performing better.
Wow. So much for market trends.
Right. Just shows you those trends can be fleeting.
Totally.
What's hot today might not be tomorrow.
Exactly.
It's a good reminder to do your own research.
Always.
Don't just blindly follow the crowd. So when it comes to valuing growth stocks, Graham offers a simple formula
Okay.
you can use as like a starting point.
All right.
He suggests the value of a growth stock can be estimated by multiplying its current earnings by 8.5 plus 2 times its expected annual growth rate over the next, 7 to 10 years.
Over a decade.
Yeah.
Got it.
Sounds pretty straightforward.
It does. But
Right.
predicting growth rates over a decade, that's a bit of a guessing game.
Right. Like, who really knows?
Exactly.
And Graham is quick to warn about, putting too much faith in those projections.
Right.
Especially for those
So it's
high-growth companies.
Yeah.
He even points out that if a company grew at 8% forever, its value would be, theoretically infinite.
Which is impossible.
Which is impossible.
Yeah.
So got to be realistic about those growth expectations. Build in a margin of safety.
Always.
Okay. Now, another important part of this whole analysis is understanding the industry a company operates in.
Right.
Graham says assessing an industry's prospects is key. But he's also cautious about relying too much on those industry reports.
Yeah.
Interesting. Why is that?
Well, by the time that information is out there, publicly available, the market has probably already priced it in.
So it's like trying to profit from yesterday's news.
Exactly.
So those reports, they can be informative, but they're not going to give you, some secret advantage.
They're not a crystal ball.
Now, with tech changing so rapidly these days, it seems like industry analysis is even tougher now.
It is, but it's also potentially more rewarding.
Oh, how so?
Well, those who can really nail the impact of new technologies. They could see huge gains.
Like predicting the next big wave.
Exactly.
Before it hits.
And Graham points out that analysts can use things like field trips.
Oh, wow.
Interviews with experts, deep dives into new technologies to get a better grasp on these fast-changing sectors.
So it's about combining traditional financial analysis with a forward-looking view on innovation.
Absolutely.
It's a balancing act.
It is.
This brings us back to Graham's 2-part appraisal process. Remember that.
Vaguely.
Starting with that past performance value.
Yeah.
based on historical data.
Right, setting that baseline.
Exactly. Now, for industry analysis,
Yeah.
this historical perspective is crucial.
It is.
We have to understand how an industry has performed, how it's responded to different things.
The economy, to technology.
Yeah, all that.
Competitive pressures.
We're not just looking at the now,
Nope.
but the long-term trends.
The trajectory.
And then we add in our assessment of the future.
Right.
How might things change? New tech, regulations, competition.
The full landscape.
It's like predicting the weather.
It is.
But instead of clouds,
Yeah.
we're looking at financial statements,
Exactly.
market trends, technology.
It's complex.
And just like weather forecasting, there's always some uncertainty.
Always.
So how do we balance this uncertainty with Graham's emphasis on making smart decisions?
Well, that's where the art and science of investing meet.
Okay.
You can't totally eliminate uncertainty.
Right.
But you can reduce it by doing your due diligence, analyzing the information, and remembering that margin of safety that Graham talks about.
It's like balancing potential growth with protecting your money.
Precisely.
And speaking of balancing, remember, diversification, that applies to industries too.
Oh, interesting.
So we shouldn't just focus on one hot industry. Spread our investments across different sectors.
Exactly. Don't put all your eggs in one basket.
It's all about managing risk, building a portfolio that can, weather the storms.
Exactly.
Now, let's talk about something Graham brings up.
Okay.
Towards the end of the chapter, the difference between analyst and investor.
Ooh, good one.
What's the difference?
Yeah. Are they not the same?
Aren't they basically the same thing?
Not quite.
Okay.
Graham says an analyst is mainly focused on valuing those securities, figuring out what a stock or bond is worth.
Okay.
Based on its fundamentals.
Those are numbers.
But an investor, they take that analysis and they apply it to their own goals.
Oh.
Their risk tolerance.
So it's like one person designs the building.
Yes.
The other decides whether to buy it.
Perfect analogy.
The designer focuses on the structure. The buyer considers location, price, their needs.
Exactly.
And Graham says the investor's role is just as important.
Absolutely.
In fact, he says their main responsibility is managing their emotions.
Interesting.
Avoiding those impulsive decisions.
Right, like driven by fear or greed.
Exactly.
So important.
It's having the discipline to stick to your plan.
Yeah.
Even when things get crazy.
Absolutely.
This brings us to another big takeaway from Chapter 11.
Yeah, okay, what's that?
The importance of temperament in investing. Graham believes successful investing isn't just about, intelligence.
Yeah.
It's also about having the right mindset.
So it's not just what you know, it's how you react to it.
Exactly. You can have all the tools, all the knowledge.
Yeah.
But if you panic and sell at the first dip, you're probably not going to reach your goals.
It's like a surgeon.
Oh.
Who freezes up during surgery.
Oh, yeah.
They have the skills, but not the mental strength.
Wow, that's a powerful image.
It is.
Graham says developing the right mindset.
Yeah.
It's an ongoing thing. It's a journey of self-discovery and self-discipline.
Right. And this brings us to what it truly means to be an intelligent investor.
Okay. Tell me the secret.
It's not so much a secret as it is a mindset. A way to approach the markets with a mix of intellectual rigor, emotional discipline, and a healthy dose of skepticism.
So do your research, control your impulses.
Yeah.
Don't believe everything you hear on Wall Street.
Exactly.
An intelligent investor is always learning.
Always.
Adapting, refining their approach.
They're not afraid to question things.
To think for themselves.
Precisely.
And they know that investing is a marathon.
And not a sprint.
They're focused on the long game.
A long game.
Building wealth slowly and steadily.
Exactly.
That's such an important lesson from Graham.
It is.
Investing isn't just about, picking stocks.
No.
It's about developing the right mindset, a disciplined approach.
And that long-term vision.
It's about becoming a student of the markets.
Yes.
Understanding how things work, making decisions that fit with your own situation.
And your aspirations.
Okay, as we wrap up this part of our deep dive, I want to emphasize one final point from Graham.
Okay, shoot.
The importance of continuous learning.
So important.
Because the market, it's always changing.
Always.
New industries, new tech. Economic ups and downs.
It's dynamic.
And a smart investor is never satisfied, never thinks they know it all.
They're always curious.
They're always looking for new knowledge, right?
Absolutely.
Expanding their understanding, refining their approach.
It's about staying curious.
Staying engaged.
Yeah.
Staying ahead of the game.
Exactly.
I think that's a great place to kind of pause our dive into Chapter 11.
It is.
We've covered a lot.
A lot.
But really, we've just scratched the surface.
Oh, yeah.
Of Graham's wisdom.
There's so much more there.
It's a book you can come back to again and again.
Definitely.
Always finding something new.
Every time.
So we encourage you to keep exploring this world of intelligent investing. Read books, listen to podcasts.
Talk to other investors.
And most importantly, put what you learn into practice.
Absolutely.
Because investing is a journey.
It is.
It's about learning, growing, and evolving as the markets evolve.
Right. And remember what Graham said. The best way to measure your success isn't about beating the market.
Right.
It's about having that plan, that discipline that will get you to where you want to be.
Such a powerful message.
It is.
As we navigate this complex world of investing.
Definitely.
So that concludes our deep dive into Chapter 11 of The Intelligent Investor.
All right.
Hope you enjoyed this journey into security analysis and keep exploring this world.
There's always more to learn.
The rewards of being a well-informed investor, they're measurable.
They are.
Until next time, keep learning.
Keep growing.
And keep diving deep.
Dive deep. So remember those coverage ratios we talked about earlier?
For bonds.
Yeah, crucial for bonds, but with stocks, things get a bit more, complex.
Right.
Let's look at LCOA.
Okay, LCOA.
Graham analyzed them back in '63. They were a market darling then.
So like
everyone loved them.
Great numbers, strong earnings.
I did. Yeah, consistent growth.
Kind of company everyone wants a piece of.
Exactly.
Okay.
But Graham, the astute investor he was, he looked beyond that. He saw their profit margins actually shrinking, which could mean competition was heating up.
Interesting.
And their debt, it was piling up.
Not good.
Potentially limiting future growth.
It's like that saying, right?
What's that?
Trees don't grow to the sky.
Right. Even the best companies.
They can hit a limit.
A ceiling.
Or even,
start to decline.
Yeah.
And this is where Graham's famous idea comes in. Margin of safety.
Margin of safety.
He wasn't looking for just good companies, but good companies selling at a discount. Priced lower than their real worth.
I see.
This margin, it protects you from the market's uncertainty.
So it's like a buffer.
Exactly.
A cushion in case things don't go perfectly.
Precisely.
Now, LCOA, despite their past performance, didn't offer that margin of safety.
Really?
Back in '63? No. The price investors were paying, it didn't reflect the potential risks.
That Graham saw.
Exactly.
I love how Graham's approach really makes you think.
It does.
Not just get caught up in the hype.
No.
But really analyze the value.
The fundamentals and his insights still apply today, especially when you look at, like, tech companies.
Ah, right. Back then.
Yeah.
Tech was just emerging.
It was.
But Graham already got it.
He did.
The challenges of analyzing those businesses. Because technology, it changes so fast.
So fast. What's hot today?
Right.
Could be gone tomorrow.
Exactly. And Graham warned about getting too spread out.
In the excitement of new tech, he emphasized the basics, the financials,
the company's health,
the management, how they're positioned in the market.
So it's not just about the cool new gadget.
Yeah.
It's about
how that translates into profit.
Yeah, long-term value.
Exactly. Think of it this way.
Okay.
Would you invest in a horse-drawn carriage company? Just because they had a fancy new design?
No way. The market's moved on.
Right. No amount of tweaking can change that.
Okay, I get it.
Same with tech companies. Tech is important, but it's just one part.
All right. So we've talked to companies. What about the bigger picture?
Yeah.
The industry.
The landscape.
How does Graham approach that?
He knows it's important to understand an industry's potential.
Okay.
But he's cautious about those industry reports.
Why is that?
Because by the time they're published, everyone knows the market's already reacted.
So
like trying to profit from word news.
Okay, so they can be helpful.
Yeah, for the big picture.
But not for, like, secret insights.
Not really.
And with tech changing everything so quickly,
right.
Industry analysis must be even harder now.
It is, but also potentially more rewarding.
Okay, I see that.
If you can predict how new tech will impact things,
yeah,
the rewards could be huge.
It's like, I don't know. Yeah. Surfing that wave before it breaks.
Exactly.
Yeah.
And Graham talks about how analysts can use field trips, interviews.
We're really getting out there.
Yeah, and deep research into new technologies.
To really understand those sectors.
Yes, combining the traditional with a view of the future.
Oh, okay.
This brings us back to that two-part appraisal process.
Right, like
that past performance value.
Based on the historical data.
Exactly, that baseline.
And for industry analysis.
Yeah.
That historical view is key.
It is. We got to understand how the industry has performed, how it's reacted to change.
Yeah, everything, yeah.
So we're seeing the long game.
The trajectory.
Right, and then we add in our thoughts on the future.
How might things change, yeah.
Tech, regulations, competition.
The whole 9 yards.
It's complex.
It is, a bit like predicting the weather.
But instead of clouds and wind,
right,
we're looking at
financials, market trends, technology.
So much data.
And just like with weather, there's always that
uncertainty. Right, so how do we reconcile that uncertainty with Graham's idea of making intelligent decisions?
Well, that's where, the art meets the science.
Oh, okay.
You can't eliminate uncertainty.
But you can manage it.
By doing your homework.
Yeah.
Analyzing everything.
Yeah.
And building in that margin of safety.
Right, which Graham always talks about.
Absolutely. It's about balancing potential growth.
With protecting what you have.
Precisely.
And speaking of balancing, remember diversification. It applies to industries, too.
Right. You don't want to
put all your eggs in one basket.
Exactly.
Spread those investments around.
Different sectors, different risks.
So it's all about risk management.
It is.
Building a strong portfolio.
One that can weather the storms.
Now, let's switch gears a bit.
Okay.
Graham brings up something interesting.
Oh, yeah.
Towards the end of the chapter.
Okay.
He talks about...
What's that?
The difference between an analyst...
Analyst?
And an investor.
Ah, interesting.
What's the difference?
Yeah, aren't they basically the same?
Aren't they basically doing the same thing?
Not necessarily.
Okay.
Graham says an analyst.
Yeah.
They're focused on valuing securities.
Right. So figuring out what a stock or bond is worth.
Based on those fundamentals.
The number.
But an investor,
yeah,
they take that analysis.
Okay.
And they apply it to their own personal goals.
I see.
And risk tolerance.
So like...
It's like one person designs a building.
Okay.
And another person decides to buy it.
The designer focuses on the structure.
Yeah.
The buyer thinks about location, price, their needs.
Exactly.
And Graham says the investor's role...
It's equally important.
Is just as important.
Yeah.
He even says their main job...
What's that?
Is managing their emotion.
Yeah, interesting.
Avoiding those impulsive decisions based on...
fear or greed.
Exactly.
So important.
So it's about having discipline.
Discipline, yeah.
Sticking to your plan.
Even when things are volatile.
This brings us to another big takeaway from the chapter.
Okay, I'm listening.
The importance of temperament in investing.
Temperament?
Graham believes success isn't just about, like, brains.
It's more than that.
It's about having the right mindset.
So it's not just what you know, it's how you handle it.
You could have all the knowledge in the world.
Yeah.
But if you panic and sell everything at the first sign of trouble...
You won't reach your goals.
You're not going to reach those goals.
It's like, imagine a surgeon
who
freezes up in the middle of surgery.
Oh, wow.
They have the skills.
Right.
But not the mental strength.
That's a powerful image.
It is.
Graham says developing the right temperament.
Yeah.
It's a journey.
It's ongoing.
Of self-discovery, self-discipline.
So true.
And this leads us to...
the essence of being an intelligent investor.
Okay, give me the secret.
It's less a secret, more a mindset.
Okay.
It's how you approach the markets
yeah.
with intelligence, with discipline, and a good dose of skepticism.
So do your research.
Yes.
Don't get swept up in emotions.
Oh,
And don't believe everything you hear.
Especially on Wall Street.
Right.
An intelligent investor is always learning, adapting, refining their strategy.
They question things.
They do.
They think for themselves.
They're independent.
And they understand that investing...
It's a marathon.
Not a sprint.
Long game.
Slow and steady wins the race.
Exactly.
That's a powerful lesson.
It is.
Investing isn't just about picking stocks. It's about the whole mindset.
The approach, the long view.
Becoming a student of the markets.
Yes.
Understanding how it all works. Making decisions that fit your life.
And your goals.
Okay. as we wrap this part up,
yeah,
I want to highlight something else Graham says.
what's that?
The importance of continuous learning.
You can never stop learning.
Because the market
is always changing.
New industries pop up.
New technology.
Economic ups and downs.
It's dynamic.
And a smart investor.
Yeah.
They never get complacent.
They're always seeking new knowledge.
Always expanding their understanding.
Refining, adapting.
So it's about
staying curious, engaged.
Staying ahead of the game.
Exactly.
I think that's a great place to pause for now.
It is.
We've covered a lot.
We have.
But really, we've just started to explore Graham's wisdom.
It's a deep well.
This book, you can come back to it.
Again and again.
Find something new each time.
Absolutely.
So we encourage you, keep exploring this world. Yeah, keep learning. Read books. Listen to podcasts.
Talk to other investors.
And most importantly,
put it into practice.
Yeah, because investing is a journey.
It is.
It's about growing, evolving with the markets.
Remember what Graham said. The way to measure success isn't about beating the market.
Right.
It's about having that plan, that discipline.
That will get you where you want to go.
Exactly.
What a powerful message.
It is.
As we navigate this world.
For sure.
Well, that wraps up this part of our deep dive.
Okay.
Into Chapter 11.
Of The Intelligent Investor.
Hope you've enjoyed this look at security analysis.
It's fascinating stuff.
And remember, keep exploring.
Keep learning.
There's always more to learn.
Always.
And the rewards of being an informed investor, they're huge.
They are.
Until next time.
Yeah.
Keep learning.
Keep growing.
And keep diving deep.
Dive deep.
Welcome back to our deep dive, into Benjamin Graham's The Intelligent Investor.
It's been quite a journey.
It has. We've talked about so much.
From bond ratios to
like valuing those growth stocks.
Complex stuff.
But for me, one of the biggest takeaways from Chapter 11 is that investing success.
Yeah.
It's as much about temperament as it is about intellect.
Absolutely. Graham really highlights that difference between the analyst and the investor.
Right. The analyst crunches the numbers.
Yeah, they figure out what it's worth.
But the investor...
But there the rubber meets the road.
They take that analysis and apply it...
to their own life, their goals.
It's like having a roadmap.
Okay.
Versus actually driving the car.
I like that.
The map shows the way.
Yeah.
But the driver... They got to handle the car.
Deal with traffic.
Yeah, make adjustments along the way.
And stay calm.
Especially when conditions are tough.
Exactly. A good investor.
Yeah.
They have to manage those emotions.
Right. Avoid those impulsive moves.
Stay disciplined.
Even when the market's going crazy. Because fear and greed, they can really mess with our heads.
They can. It's easy to get caught up in the frenzy.
When everyone's buying or selling.
And that's where Graham's advice comes in.
About being businesslike.
Treat your investments like a business.
So no gambling.
No chasing those quick wins.
Thinking long term.
Exactly. A true intelligent investor.
Yeah.
They approach the market with a balance of intelligence, of discipline, and a healthy dose of skepticism.
So do your homework. Control your impulses.
Don't believe the hype.
And they're always learning.
Always adapting, refining.
Not afraid to challenge the status quo.
Thinking for themselves.
And they understand. Investing, it's not a sprint.
It's a marathon.
Slow and steady.
Building wealth over time.
That's such a crucial lesson.
It is. Investing is more than just picking stocks.
It's about the mindset.
The discipline, the long view.
Becoming a student of the market.
Understanding those forces at play.
Making decisions that align with your life.
And your goals.
As we wrap up this deep dive,
I
want to highlight one last point from Graham.
Okay.
This idea of continuous learning.
So important.
Because the market's constantly changing.
Always evolving.
New industries.
New tech, economic shifts.
The smart investor.
Never stops learning.
They're always seeking new knowledge.
And expanding their understanding.
So it's about staying curious.
Engaged.
Staying ahead of the curve.
Precisely. And I think that's a good note to end on.
Yeah.
For our deep dive into The Intelligent Investor.
We've covered a lot.
But really, we've just scratched the surface.
Of Graham's wisdom.
It's a book worth revisiting.
Again and again.
Finding new insights every time.
And we encourage you to keep exploring.
This world of intelligent investing.
Read more. Listen to more podcasts.
Talk to other investors.
And most importantly,
put what you learn into action.
Investing. It's a journey.
It is.
It's about growth and evolution.
And remember Graham's words.
Okay.
Measuring success. It's not about beating the market.
Right.
It's about having that plan
The discipline
that gets you to your destination.
That's such a powerful message.
It's about the journey, not just the destination.
Well, that wraps up our deep dive.
It does.
Into Chapter 11 of The Intelligent Investor.
Hope you enjoyed it.
We hope you enjoyed this exploration of security analysis.
And keep learning.
There's always more to learn.
The rewards are immense.
Until next time.
Yeah.
Keep learning, keep growing.
And keep diving deep.
See you next time.